In trading, a bull trap could be a situation where a trader buys an asset believing its price will still rise, only to work out it falls sharply after reaching a brand new high. Bull traps occur during times of market uncertainty or when false information is circulating a few particular asset. It's called a bull trap because traders who are none the wiser are made to believe that a declining asset is really on the increase. This false sense of security can result in heavy losses. When a bull trap is suspected, traders should exit the trade immediately or enter into a brief position. Stop-loss orders are available in these scenarios, especially if the market is moving swiftly, to avoid being caught in a frenzy by emotions. Like plenty of things in trading, identifying a bull trap may be difficult. However, the simplest way to avoid bull traps is to note warning signs in advance, such as low volume breakouts. In today's video we will discuss this in details. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex and many more. So watch this video till the end and hit the subscribe button. And click on the bell icon to get notifications for our future videos. So let's begin the video. How does a bull trap work? Bull traps can result in severe consequences for those purchasing during a perceived reversal. Let's say you are looking at a chart of an asset in a very downtrend. After a long time, the value reaches a degree where it starts to consolidate sideways in what's called a range. During now, the bulls and bears are locked in battle as they fight to push the worth in opposite directions. The bears are attempting to push the value all the way down to new lows while the bulls are fighting to stay the worth up. At some point, there's a breakdown from the range because the bears win, and also the price falls to a replacement low. Just when it looks like the downtrend is on the point of resume, however, the bulls make a comeback and push the value duplicate to its previous high. Many traders see this as a bullish reversal and begin buying, thinking that the downtrend has ended. Unfortunately, this can be usually just a short-lived move, and also the price soon resumes its downward trend, resulting in heavy losses for those that bought at or near the highest. What does a bull trap mean in the crypto market? Also stated as dead cat bounce, bull traps are often seen in crypto thanks to speedy recoveries. In crypto, bull traps work as they are doing in the other market. For example, if the value of an altcoin has been rising steadily over the past few days, you will believe it'll still rise. You get some and expect the worth to travel up, so you'll sell it at a profit. However, the other happens, and you discover yourself trapped in an exceedingly losing position. You witness the downtrend and so look ahead to a bullish reversal once you should buy the dip, thinking you're purchasing the asset at a decent price. The trap reveals itself intrinsically when the value retreats and goes back on the downtrend. Role of psychology in bull traps. Bulls chase and ride the high of bull conditions, which might all be in good until the following securities industry returns. When this happens, they'll get caught during a bear trap where they'll liquidate their position at a loss. Thanks to a unidirectional mentality, strictly bear or bull, investors acquainted with trading in a very securities industry might constitute the trap of shopping for high and selling low. Experts suggest having a bidirectional mentality to achieve both bull and bear markets, as this permits for greater profits during long-term trends. What are bull traps used for? Bull traps are employed by both day traders and long-term investors to require advantage of unsuspecting market participants. For day traders, a bull trap is a chance to short the protection because it rallies keep a copy to the previous high. The worth will then resume its downtrend, resulting in profits for the trader. For long-term investors, a bull trap is a chance to shop for the safety at a cheaper price because it falls go into reverse after the rally. They're then ready to hold the protection for the following uptrend. What causes a bull trap? One of the most frequent causes of a bull trap is a lack of purchasing volume on the rally back up to the previous high. Weak buying volume is a sign that there is not much interest within the security at a selected low price, which the bulls aren't strong enough to push the worth higher. Another common reason for bull traps may be a false breakout from a consolidation pattern. The value breaks out of a variety to the upside, then again quickly falls backtrack and resumes its downtrend. How to identify a bull trap? Here's how to spot a bull trap with some telltale indicators that one is on the way. RSI deviation. An indication of a probable bull or bear trap could be a high RSI. Calculating the Relative Strength Index, RSI, might help you spot potential bull or bear traps. Technical indicators like the RSI can show whether a stock or cryptocurrency asset is neither overbought nor underbought, or both. The computation typically covers a period of 14 days, although it can also be used for different time periods. Due to its removal from the formula, the period has no bearing on the calculation. In the case of a potential bull trap, an elevated RSI and overbought conditions imply that selling pressure is escalating. The trade will almost certainly be closed out at any time because traders are anxious to collect their profits. Therefore, the initial breakout and upswing might not be a sign of ongoing price increases. Lack of volume growth. Because more individuals are purchasing the security as it rises higher, there should be a significant increase in volume when the market is actually breaking out to the upside. There may not be much interest in the asset at that price, and the rally may not be long-lasting if there is little or no rise in volume on the breakout. Bots and retail traders jostling for position may also be the cause of a price increase without a noticeable increase. Lacking momentum. A bull trap is present when a stock experiences a dramatic dip or gap down with big red candles followed by a very gentle rebound. The market will always move in cycles by nature. When a cycle hits its peak, there is typically a period of consolidation when the bulls and bears compete for dominance. This lack of momentum can be viewed as a precursor to the market's impending turn. Absence of trend break. A series of lower lows and lower highs indicates a price drop. When advancements are made, trends in stock prices don't necessarily shift. As long as the price gain falls short of the most recent lower high, a downtrend is still present. One of the most common errors made by people caught in bull traps is a lack of confirmation. They ought to be aware that it is in a downtrend or range if the current high does not exceed the previous high. Unless you have a compelling reason, this is often regarded as a no man's land and one of the worst areas to start a buy. The majority of traders would rather wait for confirmation and buy at a higher price than try to get in early and end up being trapped, which may disappoint some traders. Retesting of resistance level. A strong bullish momentum that has been maintained for a long time yet reacts quickly to a specific resistance zone is the first sign of an impending bull trap. A stock is said to be in a strong uptrend when there is little bearish pressure, which suggests that buyers are pouring all of their resources into the stock. However, the price will often revert before rising much higher if it encounters a resistance level that it is hesitant or scared to breach. Startling huge bullish candlestick. In the last stage of the trap, a huge bullish candle usually takes up most of the immediate candlesticks to the left. This is generally a last-ditch effort by the bulls to take control of the market before the price reverses. It could also occur due to several other reasons. Big players are intentionally pushing the price higher to entice unsuspicious buyers. New investors are confident that a breakout has occurred and begin purchasing again. Sellers intentionally let the buyers dominate the market for a short period, allowing sell limit orders above the resistance zone to be accepted. Formation of a range. A bull trap configuration's final characteristic is that it results in a range-like pattern on the resistance level. When an asset's price changes within a range, it is referred to as bouncing back and forth between a support and resistance level. This range may not be ideal, especially at the top end, as the market may still be producing smaller, higher highs. Yet the massive candle mentioned earlier forms and closes outside of this range, signaling the beginning of the bull trap.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.